Michael Arougheti joins us now, co-founder and CEO at Eris Management. Michael, wonderful to catch up with you, sir. I think we need to talk about speed, just how quickly this is moving. What do you make of it all?
I think you hit on a big challenge in today's market environment relative to past cycles. I think with the speed with which money can move through the system, the speed with which information is coming at us, it's getting harder and harder to distill the signal through the noise.
So we're talking with you, Michael, at a time when people are wondering who will take over some of the institutions that are seeing some distress, who will come to the rescue. And we were talking with Bill Dudley about how big banks learned their lesson during the financial crisis and are concerned about litigation risks. From your vantage point, given that Ares oversees $352 billion of assets, including more than $200 billion of credit, what's your view on that? Where is your role?
It's interesting. I think the private credit markets have been playing a little bit of a stabilizing role here over the last couple of weeks and months as liquidity in the traded markets is not what it used to be. I think folks like Ares are coming in and really providing liquidity in certain markets where liquidity has gotten thin. One thing I think about now as one of the larger private credit managers is we don't know exactly how this all will unfold, but I can tell you one thing. We will see more regulation of banks, both mid-sized and large. We will likely see a change to bank capital regulatory framework here in the U.S. and abroad. And that capital contraction will make it ever more important that private credit plays a role in funding the real economy.
So at what point, and I want to go to the funding the real economy in a second, but just in terms of the here and now, is Ares going in and picking up bank bonds? Is Ares coming in and discussing how to finance banks that perhaps are threatened with deposit outflows?
I mean, I remind you, Lisa, we play strictly in the private market. So we do have certain pockets of capital within our opportunistic credit and distressed businesses that will dabble in the public market opportunity that gets created here. But the opportunity set for Ares and those that look like us really is to come in and be a liquidity provider to the small companies that may be challenged to get liquidity from mid-sized and regional banks. And it could be as a real good counterparty to the banks on reg cap trades as they try to revisit the liquidity on their own balance sheet.
You talked about the broader capital sphere that we're watching and this concern about whether commercial real estate operators as well as individuals and small businesses can get the loans that regional banks used to provide to them. Michael, private credit might step in, but how much more expensive will it be to get it from a private equity company or a private debt firm than from a regional bank?
Look, I think historically the private credit markets have been more expensive. That's largely because they tend to provide a level of creativity or innovation or frankly more leverage or structural flexibility than a bank solution could. So I think the market is pretty well attuned to a higher cost of capital. I think you raise an important point, though, here is what we're dealing with now is liquidity and duration, not credit. And we're already seeing the impact that cost of capital is having as rates are moving up so quickly. I think we first need to get to a point where the equity valuation environment adjusts to the new reality so that people can actually afford a higher cost of capital if that's where this takes us.
Michael, one issue that's come up repeatedly over the last week is this idea that ultimately now we'll end up with tighter lending standards, tighter financial conditions. I think a lot of people are lining up to give us the stats about how dependent certain parts of this economy are on the financing from small and medium-sized banks. We're thinking about real estate a whole lot more. Michael, how are you thinking about the ripples from what's developed in the last couple of weeks from these banks and what regionals are going through and what it means for an asset class that I imagine you're exposed to?
Look, I think it could be very challenging. I think that the Fed is doing everything it's supposed to do to step in and provide confidence. I was pleased to see the larger banks in the market step in to provide support to First Republic. I think at the end of the day, again, this is duration, liquidity, and confidence, not credit. So I would hope that folks calm down, again, see the signal through the noise and get back to lending. But it is a real risk, obviously, to the extent that people continue to lose confidence. capital leaves that part of the banking sector, and it is going to make it harder for people to access capital for sure.
It feels like a year ago, but last week, Larry Fink of BlackRock said that there are a number of shoes that are going to drop. First, it was Silicon Valley Bank. Then it was other smaller and medium-sized banks. And next, it would be the private credit and private equity and venture capital markets that wouldn't get that credit. Do you agree with that?
I think one thing that is probably most misunderstood about the private markets, which is why, it's always been this view that they're the canary in the coal mine, and yet every time we have a crisis or a mini crisis, private markets tend to emerge fairly unscathed. And I think the big difference that folks don't really appreciate is, one, most private credit assets are held unlevered. To the extent they're levered, they're modestly leveraged with match duration and match funding. Juxtapose that with a bank that is 10 to 15 times levered, and you get obviously a much different outcome in markets like this. Similarly, on the equity side, they are operating out of funds with 10 to 12-year life cycles. And so most private owners of assets that are institutionally backed are neither forced sellers or forced buyers in any market, and that provides a level of stability that I think people may underappreciate when we go through markets like the one we're in right now.
That's a constructive point, Michael. We've got to leave it there. It's wonderful to hear your thoughts. Thank you. Michael Arougheti there of Ares Management.